Good day everyone, my name is Fatika Sri and I will process matrix ID 10 DLS23 F104T1. Today I will be presenting the financial ratio analysis for KEC company covering 4 main categories, that is liquidity, efficiency, leverage and profitability. Let us start by analysis each category in detail. Firstly, we move into the liquidity ratio, which helps us to understand KEC ability to meet its short-term obligation. For the current ratio, the formula is current assets divided by current liability. KEC has current asset of 1,350,000 and current liability of 360,000. Thus, the current ratio is 1,350,000 divided by the 360,000, resulting in 3.75. This is higher than the industry average of 3.5 times. This is favorable, indicating that KEC is in strong position to meet its short-term liability. For the quick ratio, the formula is current asset minus inventory divided by current liability, with the current asset of 1,350,000, inventory of 600,000, and current liability of 360,000, and the current quick ratio is 1,350,000 minus 600,000 divided by 360,000, giving 2.08. This slightly above the industry average of 2 times. This is favorable, showing that KEC can cover its immediate obligation even without depending on the. Next, we continue with efficiency ratio, which assess how well KEC is using its asset. For the inventory turnover, the formula is cost of goods sold divided by inventory. Therefore, inventory turnover is 567,000 divided by 600,000, resulting in 0.945. This is better than the industry average of 0.8. This is favorable, showing that KEC is managing its inventory efficiently. For the collection period, the formula is account receivable divided by sales multiplied by 360. Therefore, the collection period is 150,000 divided by 945,000 multiplied by 360, giving 57.14 days. This industry average 30 days. This is unfavorable, as it shows that customers are taking longer than expected to pay, which may hurt the cash flow. For the total asset turnover, the formula is sales divided by total assets. Therefore, total asset turnover is 945,000 divided by 1,668,000, resulting in 0.566. This is slightly better than industry average of 0.5 times. This is favorable, indicating that KEC is utilizing its total asset reasonably well to generate the sales. For the fixed asset turnover, the formula is sales divided by net fixed asset. Therefore, fixed asset turnover is 945,000 divided by 380,000, resulting in 2.97 times. This is better than industry average of 2.8. This is favorable, showing that KEC is using its fixed asset effectively. Moving on to leverage ratio, which measures financial risk and extent to which KEC use debt. For the debt ratio, the formula is total liability divided by total asset. Thus, the debt ratio is 660,000 divided by 1,668,000, resulting in 39.57%. The industry average is 35%. This is unfavorable, as it indicated that KEC is more reliant on debt than the industry standard, which increase financial risk. Finally, we analyze the profitability ratio, which reflects how well KEC generates profit. For the net profit margin, the formula is net profit divided by sales. Thus, the net profit margin is 92,880 divided by 945,000, resulting in 9.83%. The industry average is 50%. This is unfavorable, showing that KEC profitability is lower than industry average. For the return of equity, the formula is net profit divided by equity. Therefore, return on equity is 92,880 divided by 1,008,000, resulting in 9.22%. The industry average is 20%. This is unfavorable, indicating that KEC return to the shareholder is relatively weak. For the return on investment, the formula is net profit divided by the total asset. Therefore, the return on investment is 92,880 divided by 1,668,000, resulting in 5.57%. The industry average is 10%. This is unfavorable, showing poor return from KEC asset.
My name is Luisa Ching and my matrix number is 10DLS23F1052. I'll be presenting about question B and also question C. Question B is about make and explain two main financial problems that currently faced by the company based on answer in question A. So there are actually got two main financial problems faced by the company in current situations. The first one is low profitability ratio, which our company net profit is 9.83%, which is below than the industry average of 15%. This is shown that the lower efficiency in converting the sales into profits. And also our ROE, return on equity, which is 9.22%, is significantly lower than the industry average of 20%, suggesting poor return for shareholders. And our ROI, return on investment, 5.57%, is also below the industry average of 10%, reflecting that efficiency use of total asset to generate profits. This company profitability is unfavorable across all key metrics, which could stop to the investor and limit the growth opportunities of this company. This would also potential high operating costs, pricing strategies, or inefficiency asset utilization. And the following problems is that high debt ratio, which our debt ratio is 59.57%, exceed the industry average of 55%, signaling higher financial risk due to reliance on debt's financial. Unfavorable debt ratio would have potential difficulties in meeting long-term obligations, which it could lead to higher interest expenses and also reduce the financial flexibilities. This would also affect the company ability to secure the future financing. And of course, we found out some solution to overcome these two main financial problems that occurs in our companies. So the first one is improve our profitability through cost optimizations and revenue enhancement. The best practice is that cost control, which we can identify and reduce the unnecessary operating expenses such as overhead costs, inefficient procurement. The lean management technique implementations is to streamline the operations. And the second solution is that we can implement to reduce debts and optimize capital structure. The best practice is that debt restructuring, which is we can negotiate with lender for a lowest interest rates or longer repayments terms to ease the financial pressure.